Good morning. Happy Thursday. Welcome to Breaking Through the Disruption, our webinar series from RE Journals. First thing I got to do is say hello to everybody online. Thanks for joining us. I bet you're tired of watching webinars and not getting together. I can tell you we are too. Thanks to SIOR, CCIM, and groups like this that have helped us sponsor these events. We've been able to pivot from doing live events to webinars. Without sponsors, we wouldn't be able to do that. So a deep thank you to all these people who have allowed us to keep our team working and pivot into webinars. This is us. For those of you that don't know, we are now a much bigger company. So we acquired a group out of Chicago, RE Journals, and we acquired a group out of Texas, Red News. So now these are our 6 publications, and we were planning on doing 104 live events this year. Now we're going to hopefully do all of those, plus this is our 35th webinar. So thanks for joining us. Today's webinar has been approved by the Minnesota Commissioner of Commerce for 1 hour of real estate continuing education. What does that mean for you? The first thing is it means I have to track your attendance. When you logged in today, it took your name and time-stamped it. But I still want you to go in the chat room and put your name in there and company one more time. Just kind of a belt and suspenders approach. Make sure that we have that and we have you logged in. Now, during the event, if you're here for CE, you're one of the 100-some people that paid to get CE credits for this. You have to pay attention. I'm going to ask 2 questions throughout this webinar. You have to go in that chat room to the right and answer those questions within a reasonable time period in order to get credit for this class. You also have to stay for the entire class. So we'll be done in 1 hour. Make sure you don't log out before then. If you have login and log out issues, that's okay. Don't panic. If you log back in, we'll see that. If you have continued issues, feel free to email me or Katie or somebody at our company will help you do that. So this goes to the reconnection issue. I'm showing 4 bars. I know all of our speakers are showing really good connections right now this morning. So if you have a connection issue, it's probably on your end. It's you, it's not me. All you have to do is hit that reconnect button. So if Steve Buss is talking and he freezes up, hit that reconnect button. That should fix it. If that doesn't fix things for you, check to make sure you're using Google Chrome. That's the best browser we found. You can also do this on your iPhone, iPad, or any other device. Just go back into that link we sent you, click on that, whatever device you're on, you'll be able to watch it. There. Chat room, again, to your right. If you're on a computer, below if you're on a cell phone. I'm going to skip the polls for today. All of our webinars are being recorded and they're put on our YouTube channel. But even better than that, we have a home on our website. So rejournals.com. That's all you got to remember. Go there, click on webinars. You can see all of the upcoming events and all of our past recorded events. And gentlemen who are speaking or anybody else who wants to forward the address to the YouTube video, if you don't know how to do that, you can send me a note and I'll give you instructions. Today, we're talking about commercial real estate investment market update. I think this is probably going to be the best event or the most important event to watch of all of the webinars we've done because we want to get you the information of what's going to happen over the next few months. I think these guys here are the driver that drives real estate, the engine, I should say, and we need to know what they and their clients are thinking in order to see what's going to happen for us. So. All right, gentlemen, I'm going to have you just do a little Hollywood Squares. Introduce yourself. We'll start with Steve. Tell me what you're doing, and go through your job title, where you work, what you're working on. But I want to hear really what are you doing today? We're week 8 of COVID. Likely have been working remotely. Clients are working remotely. Probably have tried to close some deals and probably trying to get some new ones in. So, Steve, we'll start with you, and you're on.
So my name is Steve Buss. I'm the managing director of the JLL Capital Markets practice in Minneapolis. We've got an office and a multifamily sale team. We've got a broader debt team, particularly on the multifamily side, and we work across product types in this market. The last 8 weeks, I have been working at home. I'm on the wave 1 coming back to the office. I prefer to work with people around. I love my family. But we all could do with less of me around the house, I think, when the time's right. So this market, in terms of what we've done, is either we had deals in the market that we have slowed down. We have deals that didn't make because of this that we're working to put back together. We're doing broker opinions of value to talk about new assets that would come to the market, maybe this summer or more likely this fall. So we have not stopped closing deals in the last couple of months. It's gotten increasingly more difficult. The market is getting better and unthawing the last couple of weeks in particular. So we are getting ready to transact more in an environment where it was really challenging, frankly, the last 8 weeks to get anything done because people just didn't have clarity on the market. They were focused on their internal teams and people and their portfolios and less interested in talking about doing deals and more focused on what they had to do in the moment. They're starting to free up now and have conversations about what do we want to do over time, and that's starting to happen.
Excellent. And Mark Colesrud, to you.
My name is Mark Colesrud. I have not been working in the office. In fact, I've barely been in Minnesota. I've been all up to the cabin, and I'm in Florida right now working from here. I've been fortunate to be in this business for 35 years, and it is a great business. And one of the reasons why it's such a good business is that the ups and downs happen, but we have such good people that in our industry that you kind of want to work in the good times and the bad times. I'm a member of 6 people on our team. I'm just one of those members, and we have had a really good 2019, and we had a crazy good 2020 first quarter, and then all this happened. But in spite of all of that, we were fortunate enough to close a large transaction with Link and for $650 million, which was a career maker for myself. And so just humbled to be a part of that transaction. And we are now spending a lot of our energy and time talking to people about the deal that we're not moving forward with or the deal that they want to get going. So I think everybody is just excited to kind of get on the other end of this event and move forward from there.
Amen. Let's get things moving. Mr. Holtz, to you.
My name is Tom Holtz. I've been with CBRE for 41 years, and I'm part of a team of 11 people with 5 professionals, including Ryan Watts, Judd Welliver, Sonia Dussel, and Bentley Smith. Our team focuses on multi-tenant and single-tenant office and industrial. We have a national practice. Typically, we will do 20% of our revenues outside of the state of Minnesota. We've currently got deals in a couple of different states that are slowly but surely progressing. I looked at our book of business in mid-February, right before the COVID situation really hit. And at that point, we had closed 5 deals. We had 5 under contract. We had 12 different listings, and we had been awarded 4 new assignments. So 26 different transactions in various stages. If you look at where we are today, middle of May, we have now closed 9 deals for the year. So we closed 4 during the COVID crisis. We've got 9 under contract. We have 16 listings today, and we've been awarded an additional 6. So a total of 40 transactions. So during COVID, we have seen an increase in activity from 26 transactions to 40 transactions. Later on, I can speak to a few of the deals that closed and some of the things that we're seeing, but I'll leave it there for the time being.
I would have bet you $100 bill this morning that you hadn't increased in transactions. So that's interesting. Avery, we're on you now.
Great. Good morning, everybody. I'm Avery Tyser. I'm a managing director at Cushman & Wakefield's capital markets practice here in Minneapolis. I'm on a 5-person team with Terry Kingston, Tom O'Brien, Scott Pollock, and Sam McGuire. We focus on office, industrial, and medical office. And we've had a good start to 2020. We sold the West End office park at the West End. And then right when COVID sent us all to our houses, we closed on the Amazon fulfillment center in Shakopee, which set a new high watermark for the market. And we had several deals that have been put on hold during this time, like everybody else. What's interesting is we have picked up about 5 to 6 new assignments over the last 5 weeks. Investor sentiment we've observed has been Some sellers want to kind of capitalize on what the value they've created before, and concerned that maybe the market gets a little, fundamentals may soften and pricing may decrease in the fall. If that's the case, or it's just groups that have said that they just have some timing issues that want to execute. So we've been busy. We're starting to see more pricing and BOV activity pick up over the last 30 days. And so overall, we've been busy. It's obviously doing some different things that we did 60, 90 days ago, but we're active and have some new assets coming to market in the next, call it 30 to 45 days.
Okay, I got to pick apart some of the things you said because you made some good comments there very quickly. Hang on, I want to get my mug out of the way. There we go. Now we can see you. So you had deals that came off the market, right? Mm-hmm. You said after this. So tell a little bit about what was the thought process behind those sellers. What were they thinking?
Sure. Some of those sellers that we were working with, they were a little bit concerned about around the uncertainty of the depth of what COVID was going to mean. And so we had a couple of assets that were going to take bids right around March 15th or 20th. And at that point, there was some obviously a height of uncertainty. And so they wanted to just hit pause. And we just have been monitoring the market and talking to our buyers, and they're now starting to come back into the market. So that's been a positive sign, and it feels like investor sentiments come back over the last 45 days to where they're ready to start looking at new deals and kind of starting to focus back, where maybe 60 days ago when we all went home, that wasn't the case. There was more discussions about walking away from what people had under contract, maybe losing out on some hard earnest money. But now the sentiment definitely feels like it's shifted, particularly in the industrial space.
Right. So are those people that put their deal on pause, I assume you're talking to them if at intervals between now and then, are they coming back, those particular folks?
Absolutely. They're coming back. Plus, there's some new entrants to the market. I wouldn't say every investor is back looking at assets, but for the most part, the groups that were looking at some of our deals previously are back in the market and ready to submit offers. Had a couple calls this morning with investors that are kind of asking about an upcoming bid date and if there might be a chance to preempt the process. So I would say investor sentiment has come around quite a bit over the last 30 to 45 days.
Well, we'll get into what's going on in the future, but presumably they think they might get a off-market deal and because of the challenge market.
I think so. I think it's interesting if you talk to investors, it feels like on the industrial space for core industrial, there's really not going to be much of a discount in our opinion, just given the capital flows that are going to be coming into, more capital flowing into the space. And I think investors recognize that if you're trying to buy a new bulk project with minimal finish, that demand is probably going to be stronger than it was maybe even pre-COVID.
Yeah.
So that's what we're seeing.
Well, Tom, let's go to you. Talk about the last 8 weeks. How has your stuff evolved, and what happened in the early days of COVID?
So we had quite a few transactions, and we were taking bids, right when the COVID thing hit. And one of the transactions that we closed was a multi-tenant industrial deal down in Des Moines, Iowa. And this deal was fascinating because the buyer and seller had agreed. We found a lender on the day of closing. The lender didn't show up, which, you can imagine caused all kinds of issues. So there were threats of lawsuits, and eventually the lender came back and ended up successfully negotiating an escrow for some rent covering roughly 12 months of rent from some tenants that were suspect in nature, and the lender ultimately closed that deal. So, it was fascinating to watch right in the middle of this COVID situation, how lenders were behaving and buyers and sellers. We had another deal that we brought to market pre-COVID. It was a sale leaseback transaction, pre-COVID, we took 3 rounds of bids. We had roughly 15 offers, and we selected a buyer. Well, then COVID hits, and probably 80% of the buyers put their pencils down and said, we're out. Ultimately, and then obviously with the debt markets in total turmoil, we were able to structure a transaction with an institution on an all-cash basis. They had an acquisition line of credit, and they loved the credit behind the deal, so that was able to get closed. We also recently have taken bids on a 10-year build-to-suit, another industrial deal in the tertiary market. This deal has excellent credit, and we had taken bids previous to the COVID thing blowing up. And in that particular transaction, we're going to see about a 75 BIP spread in pre-COVID to post-COVID pricing, but it appears that that deal is now going to get completed as well.
Ouch, that's a big repricing though, 75 bips. Hey, tell me about this lender. So figuratively didn't show up or literally didn't show up?
Just said that they weren't going to close, and it didn't happen until the day of closing.
Okay. And that was the day of, they said, we're out.
Day of.
Holy cow. I remember the last recession. I think I threw something at the wall one day when a lender said they wouldn't close, but never the day of. So that's a whole new story there. Let's keep moving here just because I don't want to spend our whole time talking about what happened in the past. But Bus, what did you have going on the last 8 weeks, and how have things turned out?
We had, there's a few. We have a number of office deals that are in the market, were in the market. Some that didn't make because they were non-refundable, and this volatility hit before the buyer had to commit, and they just said, "Hey, I may buy this later, but I'm not so sure at the moment, given what's going on." Put some deals under letter of intent, more on the long-term lease, single-tenant side. There's an industrial flex building in town where that's happened. During COVID, it actually went out to the market during this volatility, which is the only deal we formally released in this market. So what people have been waiting for, so the conversation we're having is people are waiting for things to happen. So the first gate was, can we get debt? The answer is yes. There is debt out there. It's available. It's priced differently because the benchmark rates have dropped so much. The nominal interest rates aren't that different than before all this hit. Proceeds are down in some cases. Not all the lenders are there, but we can make a market for debt on almost any commercial asset. So office, industrial, multifamily. Multifamily, the agencies never went away, which helped, and the life companies have come back as well in the last few weeks. Then people ask, now they're asking different questions, which are, in Minnesota, when is the stay-at-home order going to be lifted? And I guess we're mostly lifted in June with some exceptions. So that's going to help. But that's been a wait. So I think on the office asset side, on a multi-tenant building, I think most investors took the position, maybe I'll bid, but I'm not going to end my due diligence and close on an asset where the tenants may not be allowed to use their space. Along the way, they've also asked questions about collections in April and May. So there's a lot of questions on a multi-tenant project. Where are your collections? Same on multifamily or any asset. Those collections have been very good. On the office side, maybe mid-90%. Multifamily, mid-90%. On Class A properties in particular. So that's been helpful. I think we're going to get to a point where people are going to have to say, am I off the sideline, and answer that question for themselves. And more and more people are saying that every day. Yep, we're back. And then the harder question is where do I underwrite cash flows going forward in this more uncertain environment? And some of these bigger questions come in terms of like office buildings. How is de-densification of office space, people wanting more space per person, going to outplay against people working from home? How are those two opposing things going to work out over time? And what call do I make now on a bid to do that? The good news on well-occupied buildings is we have contractual rent. So unlike hotels, we've got commitments from tenants. So all these factors take a little bit of time to play out, and we've got some cushion because we've got contractual rents you're collecting and financing.
Did the thought previous to COVID, the thought of an investor not wanting to do due diligence or close during due diligence when no one can get in the office building, had that thought ever crossed your mind any time in your lifetime?
Oh, no, never. And just the idea that you can get an out-of-town buyer to a property. And the issue on travel now, it's not that you can't fly to Minneapolis. You can. It's for firms, they've got essential travel policies. So unless they maybe see the asset, it's not clear-cut that there's a willingness to travel by policy. And then there's some, political incorrectness to be the person that raises their hand and says, I'm going to travel. It's like, if you're in New York, for example, in a firm, it's, I want to go travel. It's a little bit of poor form given what's going on in a market like that. So.
Yeah, that's just crazy. All right. Well, we all know what Colesrud's been up to. If you don't, you're living under a rock. But tell us about anything else that's occurred in the last 8 weeks.
Well, it's
and I mean by that fishing. He's been fishing.
I was fishing this morning. That did occur. So one thing that's kind of interesting is Colin Ryan has an office deal that he's in the market with right now. His 4 best buyers are at par, at price, moving forward, and so that's happening. And I think that hearing him talk about it, their practice of debt is not affected by what's going on right now. The best buyers of that. We've had some smaller bay industrial that had 25% of the tenants stop paying rent, and so that the lender had to tapped out, and so then we had to rethink that. But what's interesting is those small bay tenants are recovering quickly, and we can't wait for the world to kind of start up again in June. So we see that should hop back to where it was. And then, Dave Bergman spent a lot of energy recently recapitalizing some deals that the operator, we got a great operator, they just probably need different capital in it. And so we're going to see all these different things are going to be going on. And as we look at the market, and then the large, sometimes the best buyers, they still just keep and they still close, right? And so with CSM selling and Link closes at the right price without any drama. Maybe there's a little drama there for a minute, but they behave perfectly well. And with that, it's like you realize that it depends. That's going to be the most important thing that people have to realize, that every transaction is different. And with the reduction of debt, no matter what, it seems like everyone's LTV is going to drop down. So that's going to affect the transaction some more than others. And so I think we're going to see the very, very best industrial mildly change on the cap rate. I think we're going to see some of the office, that's not amenity rich. Those would be tougher to, reprice. Of course, we've talked a lot about the difficulty in retail, which also interacts so much with industrial. We went from a 15% online sale nationally to 30%, and that happened in 2 months. And so with that, now even more pressure to find and open up industrial campuses. And so, it's going to be exciting this next couple of years, I think.
I got to do a quick continuing education question. So hello, everyone. Hello. If you're getting CE, pay attention right now. Go in the chat room. This is for Minnesota CE people. Go in the chat room. Here's the first question. Demand for office space. Do you believe that demand is going to increase because people are going from, as we said on our pre-call, 150 square feet to 250 square feet per employee? Is it going to decrease because of the work from home and the issues with working in the office and riding an elevator with somebody else? Or are those two forces going to balance each other out? So your 3 choices are: 1, I believe office occupancy will increase. 2, I believe office occupancy may decrease. Or 3, I think those forces are going to balance each other out. Thank you for that. Well, let's just go back to Colesrud, because what I want to get into now, I can't believe we're already 25 minutes in. There's a lot to talk about. Let's talk about reopening And maybe I kind of want to talk about different asset classes. So let's just kick off with, we'll give you the softball. What are going to be the hot asset classes, and what are going to be the the more challenging of those?
Yeah, that's an easy pitch, but we all have heard it said that industrial is going to be the most sought after asset class. One of the things that's really interesting, and I'll make a quick comment on that, is in Minneapolis, we have such a diverse industrial market that we have so much health science and agri-science and innovation type industries that, you know, our finish levels vary dynamically, but all the same, they all still operate quite well. And so that's one thing that we'll enjoy in the industrial class. And then across the country, the comment I made earlier about retail's, you know, lift on that. But I think office, like I said, it's going to be winners and losers. Amenity is going to be a key again. You know, senior housing and you know, that's kind of like it's a separate thing. But what about student housing? You know, what happens now, and how many of the students come back, and where do they stay, and all those, you know, those markets, and then all of the development for multifamily seems to have had a nick in it, but boy, they're still talking about developing more. So I don't know. I'm not really answering your question, Todd, but I'd be a pretty good politician by now.
Perfectly fair, but I do believe I have you on record saying industrial is probably the top asset class.
Yeah, for sure.
So, Mr. Buss, if you're working on an industrial assignment, what are the buyers saying right now? What are the positives that make that attractive?
I think it's the movement to e-commerce is accelerated. So Avery's Amazon deal is a good example of that. So that's the belief. In the world this age, it's accelerated this transition in the supply chain to e-commerce, and just have more overall demand in an environment like this. So it's, you know, one thing we haven't talked about, Todd, is just the connection of the demand side for the space to the investor. That's always been the case. So just the belief in the industrial world is that the demand side of the equation for the space itself is even perhaps stronger today in terms of the go-forward look than before. And then there's question marks on the office side and on the multifamily side. You know, people need a place to live. So no matter what's happening here, so that's held up very strong. Hotel, you know, very disrupted for the moment, and won't come back till people start to travel and stay some more. Than the restaurant component of retail, just devastated in the moment. We're seeing a lot of shutdowns, a lot of announcements in Minneapolis. Some long-run great restaurants are not going to come back, and we're going to see, I think, another wave of announcements in the next few weeks. So that's unfortunate, and they're probably one of the biggest sort of victims of the you know, the stay-at-home part of this, and the inability to, you know, operate a business has some devastating consequences.
So let's do that restaurant one real quick. If you've got a mixed-use building, let's say I'm the owner, and it's mostly either apartments or office above, and I've got a restaurateur that didn't make it. Are the investors out on that deal, or can they underwrite that restaurant eventually somebody's going to take? It's a great spot. They just didn't happen to make it through the COVID.
Yeah, I think there's a couple of things happening there. Like one, like on the agency multifamily side, they're not giving credit in the loan sizing for the retail. So you're just not getting credit for it, even if the tenants are paying at the moment. So that's a loan structuring issue. That should get better as those tenants come back and are occupying their space and paying rent again, as opposed to being abated. You know, so you're not necessarily getting credit as a short answer. In the new development side, we're avoiding retail on the first floor. So we're looking at alternative uses. With owners, just on the asset management side, I think the mission and the advice to our owners that have, you know, restaurant components is that are amenities to a multifamily building or office building in downtown Minneapolis. It's, you know, keep those restaurants alive, because you will be better off as an owner helping a restaurant tenant get back into business later this year. That's a better proposition than losing that restaurant, not working with them, helping them make it, and going and finding another restaurant in a more uncertain environment. So it's keep those people in business if they're amenities to your space, work with them, help them come back when their operating model works better. That's the general advice we're giving.
And I want to follow up on the industrial piece too. You mentioned, of course, the e-commerce and how Amazon sales have spiked, and that's great for Amazon and the e-commerce market. But have you had any conversations about onshoring and more manufacturing in the U.S.? Is that something that's real, or just something people are talking about?
I think it's real. We're seeing it in the West Coast markets. I don't think we're seeing it as much in Minneapolis yet. But that's real, and it's the beginning parts of the conversation to change the supply chain and exposure to Asia. That's just starting to happen. There'll be a political aspect of that too that's playing itself out right now.
Right. Okay, Tom Holtz. So I know a lot of people probably stole your thunder, but what are the things that your investors are excited about moving forward on, and which are the things that they won't touch?
So I'll address that in two ways. I was on a global call yesterday with representatives from our New York City office, London, Frankfurt, Germany, Seoul, Korea, Singapore, Malaysia, and Canada. And our chief economists, they have kind of ranked the different food groups into A, B, and C. And in the A category, you would see both industrial and multifamily. In the B category, you would see office, and in the C category, you'd see retail and hotel. And going around the world and talking to the various professionals, they were absolutely in agreement on the desirability of what their clients were going to be looking for. I would say the encouraging thing for us here in the Twin Cities is that many of the foreign groups had overinvested in Europe last year. And so going forward, they've got a renewed interest in the cities and other U.S. markets. And I think you will see both core office and core industrial being things that the foreign investors would want to take a look at here in the upper Midwest. The other thing that I would say, Todd, is that we've been spending a lot of time working with developers on capitalizing new development deals. And there are actually quite a few build-to-suits that are being proposed. And we've been helping to capitalize those developments. And we've seen a lot of interest from industrial buyers on those deals, particularly if you have credit and if it's a good bulk distribution kind of building. The sale leaseback market has been very active. We spent a lot of time in the credit analysis, but if you've got good credit, the single tenant buyers are still out there, and there are a lot of people that are looking for yield. So if you can get over the credit hurdle and you've got a 10 to 15 to 20 year lease, you will see plenty of buyers that will still be interested in that type of product.
So let's talk about the B and C projects you mentioned, or asset classes. Is that a matter of repricing? Or I remember from the last recession, I bought some bank stocks on margin and I thought I was the smartest guy on the planet. And somebody said to me, Todd, don't catch a falling knife. And I will never forget that. Because I went ahead and bought those stocks and it didn't turn out very well. So I understood that lesson. Does that mean they're out, investors are out, or is that just simply a repricing?
I think the issue is one of pricing discovery. So most investors are looking for guideposts in terms of their underwriting. And quite frankly, we just haven't seen many office deals close during the COVID situation. So I think a lot of our office sellers have taken a pause. They may be interested in selling later this year, but they want some data points before they make the commitment to get into the market. Whereas on the industrial side, we have good data points that we can share with them, and it's a lot easier for them to underwrite those transactions.
All right, got to move on here. Avery, I'm going to flip the question around. Hang on, you're sitting down low again. I got to fix this. There we go. Now we can see you again. So the first thing I'm going to do, let's just do this, get this one out of the way. There's a really good question in here from Patrick Skinner. I've heard one opinion that with the new reality of work from home, large users of office space in first-tier high-density markets might consider establishing offices in secondary or tertiary markets. Have you heard anything like that?
That's a great question. There was a Wall Street Journal article that came out, I believe on Saturday, late last week, that had that exact reference in New York City, where some of the larger users were starting to have more locations in the suburban or different boroughs there. We do think that's likely going to happen on a national scale as well, as people go from more densified markets to either to the suburbs or to different markets altogether, where maybe rates are a little bit cheaper, you get more social distancing space. So Minneapolis would be well poised to capitalize on that trend. Absolutely.
Let's talk then. I'm going to flip this question around that I asked everybody else. You're looking at your database of sellers, and you're saying, okay, who am I going to call today? Who are the top, not, you don't have to tell me names, but I mean, what type of properties are you looking at moving? And then what's the story that you're going to tell those folks?
Yeah, good question. We've picked up, I think, 5 to 6 new single tenant assignments over the last 30, 45 days. And in each scenario, it's been somewhat of a similar fact pattern. Maybe it's a private family that had sold their company and now they're looking to monetize the real estate. Another situation had been where a family owns an asset, they've done well, they're concerned about another relapse or additional spread in the fall. And so they think that maybe pricing is better today than it will be in 4 to 5 months. So the people are sellers for different reasons. Some sellers sell because they need to for capital. Maybe they're over leveraged, or they're not going to recoup they're underwater, not recoup the initial value that they paid. And so they're looking to maybe get out of some distress. And then there's some sellers that have done really well and have said, you know what, even if the market is not ideal at the moment, we're still going to do very well, and it's time to exit and harvest our proceeds.
I think that's good advice. I'm going to take this opportunity to ask another continuing ed question. Hello. I'm supposed to ask them at random times, so this is random. If you're getting Minnesota CE, type in the box right now, answer to this question. And this is a little bit selfish because we're in the event business, and I'm concerned, just probably like all of you guys are. If there's a resurgence in the fall, this bumpy road is going to turn into a landslide or a rocky road or an impassable obstacle, right? So if you're watching this online, what are your thoughts on another shutdown in the fall that we've been hearing talk about? So yes, I believe there's going to be another shutdown or stay-at-home order in the fall, and let's just keep it to Minnesota for now. Or no, I think that's kind of overblown hype. And I know none of us are scientists who can answer that question, but just to get a feel of what people's expectations are. Let's go back to Mark Kolsrud and talk about cap rates. So what does all this mean? And then also, I think underwriting's changed, right? Reserves are up and everybody's preparing for bad things. So maybe the cap rate is different because of all those things. Where do you think we're headed?
Well, I think that there's an initial reaction that's a short-term reaction that investors expect a higher return to do a transaction when we don't have the guideposts, as Tom mentioned. It's like if you don't have the comps and the data points and you're out there making a decision to buy and move forward on a deal, you have to make some assumption that is a little bit better than what the market might have been. And so in the case of, the harder the asset class, and we already talked about those, we don't have to go get into it, but I think it's a greater spread from where that we think the market will be in 6 months than the way they are today. So in the single tenant asset, where you can understand the credit of the tenant, you know what they do for a living, you know that they're a solid company, and you probably have a reasonable LTV need. The lenders are going to be happy with that asset. And so I don't think the cap rates change at all. In fact, what I think we're going to see quickly happen is that best of best assets with good credits, because everyone's becoming experts on what the company's credit is, those cap rates are going to fall. Now, maybe not for 30 days, but it's going to happen just because the pressure for that quality of an asset is going to go up and up and up and up. And then, the repositioners, what a great opportunity to be a repositioner, because you could come into, some of these properties now and say, okay, now's my chance. I can, hop in and I can do what, because we all look back at 2008, 9, 10 pricing and say, well, why didn't I buy those buildings back in those prices now? Or the other times it's been up and down. So that's going to happen. I mean, history repeats itself. And so that for sure is going to be higher than market cap rate from a year from now. That, they're going to, some of these are going to, it's a great opportunity. So the cap rates are going to jump 100 to 200 basis points in some of those. Large credit risk is going to be the big thing that's going to cause cap rates to really change. So we might see huge swings, 250, 350 basis point swings in cap rates if the credit isn't obvious. So some of these industries are so hard hit that it'll be really industry specific as well.
Interesting. All right, let's go back to Mr. Buss. I'm assuming that there's a bid-ask gap between your different various clients. What areas is that the widest, and what are the concerns or ways you can maybe close that and get people to the table?
I'm not sure there is right now. I mean, we're very focused on where the values are and sellers who want to exact where values are now. So I think a multi-tenant product, leaving industrial to the side, and to multifamily. So multi-tenant office and multifamily properties, pricing is different today than it was 60, 90 days ago. So owner of a property that wants to sell doesn't look at the world that way. It's not something that we'll take on at this time. So we're thoughtful about that. The harder part, frankly, is buyers have to make some underwriting calls that we're just starting to see. So I can't tell you exactly right now how most office investors are going to underwrite multifamily rent rolls. But in the next 4 or 5 weeks, I'm going to have some very direct feedback for that. And I'm going to ask the bidder, we're going to ask the bidder, what did you do differently? And do that with our seller clients to understand how we got there. So I think most owners that want to transact realize the market's different. There's some exceptions that we do. I think buyers, clients, capital sources are asking the question, how are you looking at this asset differently in terms of your underwriting given everything that's happened? You need to have direct and good answers to that question depending on the asset situation. So it's not like this never happened. It's how are you being smart about this as an investor with my capital? And let's answer that question. History helps inform that. You have to take some viewpoints on sort of these bigger questions like on office assets in terms of space utilization and space per person and work at home. You've got to make some of those calls. Like if you have an asset with parking income, there's no transient parking income right now, so you have to make a call on when that's going to come back. Sometime later this year, people start coming back to work. Maybe they'll take less mass transit and that helps parking structures, which is an expectation we have. So you got to make some tough calls, but there are calls you can make. You can look back at this data to help inform.
Tom, I'm going to let you answer this question if you see it on your screen from Mark Benelli. I think that he makes a very good point here. Is this really about cap rates right now, or should we be focused on what rents, what's the new normal for rent numbers? Is our NOI going to change, and frankly, our people who are underwriting the future going to change their projections with regard to rent?
I think CB's take on that is that depending on the asset category, there may be some changes in rents and NOI, but I think the bigger concern for most investors is cash flow. And so understanding from a debt standpoint what kind of cash flows will be available, I think that will be more important than looking at potential rent growth or decline. In most of our office buildings, we've got maybe average weighted terms of 5+ years. So the reality is, unless you've got a bad credit situation, I don't think you're going to see rents go down all that much. I think perhaps one of the things that has been kind of interesting to watch, I think this COVID situation may have just given suburban office sellers a little hope. Prior to the COVID situation, if you asked most investors, they much preferred downtown office to suburban office. And I think now with social distancing and people being a little fearful of getting on public transportation, I think sellers of suburban office may be better positioned going forward.
That's interesting.
Hey, Todd, can I make a
absolutely.
Comment? So what's interesting, and Tom hit on it, and investors don't buy property with a cap rate. They buy it with what their returns will be over 10 years or whatever their hold time is. And so that's the thing, is that we'll say, hey, what was the cap rate? Well, they want to measure something against another sale. So that's what the problem with cap rate is. It's not the perfect measurement. Really, it's what's the plan? How much money are they going to make, whether it be cash flow or whatever their financial goals are. And so, the cap rates are the measurement that we all talk about. But, if rents go up, as Mark, his comment was, if rents go up, the cap rate, it changes. But what if rents go down? The cap rate obviously has to rise. So,
yeah, that's a good point. Avery, we're back to you. And so I probably want to ask the cap rate question, but what is the potential damage to NOIs over this COVID thing? And I'm going to give you one that I got yesterday too to work with alongside that. Is I had an event with a lot of apartment people who are operators, and the investment side apartment people are saying apartments are still a great asset class and we're excited, we want to invest in it. The operators are saying we're worried as heck about July and August rent coming in. It's been great. It's been way above expectations for April and May, but our NOI is going to be damaged here, and is that going to affect things?
Good question. The reality is nobody really knows what the lasting impact to NOI is going to be, because we've really only been working from home for a couple of months. Obviously, sellers and investors are really tracking receipts for rent April and May and going into June. And if we have a recovery where we're able to get back in the office and business is able to open again, then it's going to become less of an issue. But if it's a prolonged stay at home and companies aren't able to open, it's becoming a bigger issue. But I think the question that investors are going to really focus on is how viable are the companies in occupancy, and how did they perform during April and May? And is there going to be, have they lost an important customer to where their business is not going to recover long term to when the NOI is going to go down? So to answer your question, nobody truly knows. It's going to be much longer sample size. But we do think that people are going to start underwriting maybe more of a credit loss versus as high of a stabilized occupancy as previously. Maybe it's 2% less stabilized occupancy. So if you're typically underwrite to 96%, 97, now maybe it's 95. So it's going to vary by investor.
That's a good take. I think it's your room just went dark, by the way. I don't know if you.
Oh,
there you go. Something. I don't know. Well, not dark, but we're losing your video. This is a follow-up question from Dean Freeman, and I like working with the investment group because we're on the same page when it comes to asking questions. So that was kind of my next question. I'm going to go back in my history 8 weeks to when we first started doing webinars. An early webinar, a guy got on and said, an appraiser put down a blanket COVID adjustment, 20% ding to value. And in this case, they did find another valuation method to get that deal closed. But so Dean asks, have you seen any movement or anything from appraisers related to COVID?
I'm sorry, we have not. It's been a little bit early because there hasn't been enough data points on closed transactions, but we haven't seen appraisers take a blanket approach like that. There might be some adjustment, but we haven't seen a blanket 20%. Anybody else want to talk about values, current values, and closing a deal today?
8 weeks in? Have anything up for in the next couple of weeks that you're going to close? Oh, Tom, hit your microphone button for us. There you go.
Sorry. We've got a deal currently in Kansas City that we started marketing before the COVID situation. We have now, we picked a buyer. The buyer was going to use CMBS debt. That obviously blew up when the COVID thing hit. The seller has given the buyer a couple of extensions to, replace that lender. And interestingly enough, we've seen a lot of the regional banks step up and fill the void. The money center banks have kind of put their pencils down dealing with some loan issues, but the regional banks have stepped in, and we've actually got 2 lenders that have given us term sheets that are very similar to what we were looking at before. So we're hopeful. The due diligence by the lender is just being started, and we're hoping to close that in another 45 days. But there's been 0 price adjustment during this. So, that's been another interesting one to watch that's totally lender related. Todd, I couldn't hear you.
I'm the one who's telling people to turn their microphone on, and for once it's me. So there wasn't any movement on the equity either. Both the equity and the lender are clear to go on that price.
Well, the lenders, we had to go out and find new lenders, and so we've got 2 banks that are willing to do the deal and have given us term sheets. So we're just going through that, but we have not seen any retrade in pricing because the loan terms were very similar to what they were looking at before under the CMBS scenario. And as I mentioned before, for most of these buyers, it's all about the cash flow. So if they can, keep the cash flow the same, you shouldn't have a hit to pricing.
All right, I'm going to throw this out to the group again. I got to get WeWork on one of these events. And if anybody knows somebody from there that's a high up person that can answer questions, find them. I want them to be a panelist. But what happens to to that kind of shared office environment?
So we spent some time on this organizationally looking at spaces. So the traditional group, Regis, has done the best. So one that was most criticized the last 3 years as everybody else was growing has held up the best. Part of that is the configuration of the space. So the more private offices, if you're 80% privates in your co-working space, better model than bench seating in most of it. So that's playing itself through the system. I think the other issue that isn't a shock, I think, to most people is when you had short-term commitments by the customer and it gets more uncertain, they cancel, go figure, they cancel those commitments. So that realization happened again, but I think everyone, who's been around for a while realized this was a risk to the business. So when you can cancel and you're less sure, or you're a gig economy worker and you can go to the home office and cut that expense, a lot of people have made that decision in the last couple of months. So that was a risk, short-term risk to the business model we knew was there, and it played out the way I think a lot of people expected. But that private office model is the one with legs. Just the configuration issue is going to make a difference here.
Again, another change I would not have said was coming in a million years. I think we were all convinced that the open office model was the future, and now it looks like the law firms were the smartest ones with their kind of deal. Tom, let's talk about, you mentioned new development. So what's hot in new development? Is the capital there, and is it just a couple asset classes, or who's really talking about breaking ground on new projects?
It's clearly in the industrial sector. We aren't seeing any activity in the office sector, but on the industrial side, there's actually quite a bit of build-to-suit activity. And I think as a general rule, developers are not willing to take the risk of doing the capital stack and putting in a lot of their own equity. So we've been working extensively with a number of developers on capitalizing these developments. And there's definitely deals out there that are being quoted by developers, and there are investors that are interested in that product. Again, it takes extensive credit analysis and making sure everybody is comfortable with the credit behind the deal. But we're seeing actually fairly robust activity in that area right now.
So some of our other markets in the more Midwest, Ohio and Indiana, we're hearing our industrial people say that they're still going to do spec developments. Is that something, is it that hot in Minnesota, or is it still, you got to have good credit tenant to put up a building?
Yeah, I think once we come out of this, you'll see some spec industrial development, but for the time being, I think both investors and developers are shying away from taking that leap until there's a little more clarity in the marketplace.
Well, we are down to, I've got Central Time 10:55. So I'm just going to go around and do final thoughts. I know that we missed stuff. If you're in the chat room and want to ask a question, get it on there right now and I'll try to get it answered. But I'm going to start with Steve Buss and just give us your final thoughts and anything I might not have touched on.
Right. I think one real difference about this environment compared to like 2008 and 2009 is we have plenty of real estate capital available to invest when people are ready. So this is not a liquidity crisis in the real estate world. It's an uncertainty about underwriting in the short to medium term. But we have a lot of capital that's on the sidelines available to come out over time as people unpause and make underwriting decisions that they're getting more ready to make. So, fundamentally different position we're in these days compared to the last downturn.
Interesting. All right, Mr. Colesrud.
I agree with Steve's comment. Without having the liquidity, the incident, instead it was more like a 9/11, and the way we came out of 9/11 really was pretty reasonable return. And with that, I think that there's going to be great opportunity. Every time we have challenges like this, it reshuffles the deck. But in those moments, people with intentional and thoughtful process in that they can, come out of it and even be better than they were. And so I would say, we have more buyers than we have sellers. We have, really a healthy economy that we're selling out of. And so I'm pretty excited about how this looks. I just think that there's going to be a period of time that we just need to pay attention to what the market is. And rents are going to adjust up and down as we talked, depending on the product type and the credit.
Yep, keep moving around. Since Tom just said something, we're going to go to Avery. So final thoughts, and did I miss anything?
Sure. Well, we think Minneapolis is really well poised to come out of this strong from a couple of reasons. One is we don't have a heavy reliance on mass transit, which is what's hurting some of our primary markets. That's positive. We do have a strong medical device technology base, which helps our local companies here, because obviously a vaccine for COVID and producing that is going to be helpful for the firms here doing research. So that's positive. And then also our market tends to not get overbuilt. So even though we may have the fundamentals may soften slightly, we were in a really good position beforehand. So we think Minneapolis is really well positioned coming out of this, and we don't expect to see a massive hit to our fundamentals once the dust settles from this event.
So follow-up question, when does the dust settle? Is that early 2021 or?
Yeah, great question. I talking to some, people, economists, it seems to be when there's a vaccine that is produced and people have confidence that they can go out and do things. And we think maybe the vaccine creates the confidence, because right now, even if you could go out and go sit in a restaurant with your buddies, most people probably aren't signing up for that just because of the uncertainty. So we just need to get more confidence that we can go out and do these things, go to the grocery store, go to a movie theater. And as we get more and more of these types of events, that's when real confidence is going to come back. And, I'm not an economist, but it feels like once the vaccine is in place, that's when the confidence is going to accelerate.
We've been doing a lot of polling in regards to confidence because it affects our event business. How many people want to come to a live event in June, July, August, September? We're going to do one in Texas in June, and those people are ready. So that's interesting. But our polling still says 20% of the people are ready to go out right now. They're of the type of people that are like, I'm going to die someday of something, so let's go rock and roll. 50% are on the fence. So and 30% are not coming out of their house. I don't think you can convince those 30% of the people to do anything, but I think it'll be interesting to see what happens with that middle group over the next few months, if they can get out earlier or if they really are waiting for a vaccine. We'll kind of see.
Absolutely.
Last but not least, Mr. Holtz, you've got to wrap us all up.
One final comment. Yesterday on our global call, one of the participants was Marianne Teig, and she's known worldwide for her leasing ability and is clearly one of the leaders of the significant transaction leasing area. She said that office space is not dead. And you've seen a number of articles, starting with Warren Buffett and several others that claim office is going to be changed forever. Marianne raised some points that I thought she was spot on. She said that culture and competitive advantage will always trump cost cutting every time. And think about it, in the office arena, we had the private office concept, 30, 40 years ago. That morphed into more of an open layout, then hoteling, then the WeWork type space. And this is just another phase, and offices aren't going away. And as companies look to recruit and to establish culture, that will trump working from home all day long. That's
a great take, and I find myself agreeing with that. Okay, all of you people who are, I see Colesrud put his number down. Perfect. If you're online, go in the chat room, and again, this is a belt and suspenders approach. When you log out, I will probably have a timestamp, but just throw your name in there one more time, and then belt and suspenders. We know you were here. We can count you present, because I know that CE deadline's coming up, and I don't want anybody to not get credit. So thanks for doing that. Gentlemen, this is it's an honor for me to get to moderate this panel. I have looked up to the four of you for a long time, and to get to hear your take on what's coming down the pipe is, I think, important for me and everybody else. So I really appreciate everyone's time. Feel free to log out whenever you want. I'm going to keep the chat room open as people put their name in there. And I'm also going to flip through everybody's contact info one more time. And a little bit about our future. Hang on a second. I got to do this or Jeff will be upset with me. We have a lot of upcoming webinars, but we're going to slow down our webinars in the middle of June. So we have some more CE coming up. Check out our website, rejournals.com. Click on the webinar button. But there's plenty of chances to get an hour of CE in these. And then it's going to kind of taper off mid-June. So look for us to try to get live again in the near future. Thank you, gentlemen. Thanks, everybody, for watching online. Can't wait to do it again soon.